Younger people have zero chance of getting up the ladder. The median 401k in the United States of a baby boomer is $150,000. They're so fucked. You know, I don't make predictions on this stuff because it's pointless and you just get trolled on the internet for making predictions. But probabilistically speaking, from what I know today and what I know about liquidity and the regulations and everything else, the probability is that we're going to get a more violent upside cycle with lots of volatility. And it would suggest that the market peaks sometime December, end of the year, early Jan, and sharply corrects, which is exactly what happened last time Trump came in.
Pal begins by addressing a common psychological barrier among investors, the anchoring bias. This bias, he explains, leads people to fixate on the nominal price of an asset, deeming $100 more expensive than $1. However, in the world of cryptocurrency where assets like Bitcoin are fractionizable, this perspective is flawed. Instead of focusing on the absolute price, investors should evaluate the percentage potential returns. Historically, Bitcoin tends to achieve a 3x return from its previous high in each cycle, making its price trajectory less significant than its growth potential. Pal urges investors to shift their mindset, considering how much they can own and the anticipated percentage returns rather than anchoring on price.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The issue is people have this anchoring bias on price. So they think 100 is more expensive than 1. But in this weird world of crypto, everything's fractionizable. So you just should be thinking about what are the percentage potential returns going forwards. So let's say Bitcoin usually does about a 3x from the previous high, maybe more, depending where you are in the cycle. So you should be thinking about that return as opposed to the price, because anybody can put 10% of their investments in or 10% of their wages in, whatever. It's a fractionizable asset. So don't look at the number, look at what you can buy of it and the percentage potential returns. So many people anchor on things that are super cheap because they think, well, one day it could be the value of Bitcoin and therefore I'm going to make 1,000,000x returns. The world doesn't work that way. It works, Bitcoin is really the anchoring for the whole space. And over time, right, this space is a $3 trillion asset class today. If I extrapolate the trend rate of growth of adoption or price or market cap, you get to somewhere like 100 trillion by 2034, 10 years. So we're only 3% of that journey.
Mm-hmm.
So is it expensive or not expensive? It's probably very cheap. And at every point, and I've been around this cycle, I've been in crypto since 2013, everybody thinks, oh my God, I'm paying the high. And when you look back, when I paid the highs at 200 back in, well, it actually went up to 1,000 and went back down again. Back in 2013, I'm like, I paid the highs. And then I look back now and it's 100,000. That's the thing about exponentiality. People don't understand. They see the cyclicality, but they don't understand the secular exponential trend. Liquidity is actually the dominant factor.
Mm-hmm.
So right now, we look at the business cycle using the ISM survey. It's below 50, which means the manufacturing is still contracting. So, okay, we're nowhere near tightening financial conditions. They did tighten because the dollar went up and rates went up, but the Federal Reserve and the governments need to change that because we need liquidity in the system. So even if it went up every single month for 9 months, it's still September next year before you get somewhere near a peak in the business cycle. And crypto tends to that tends to be a rolling top, and crypto tends to have a rolling top around that. So I think it's longer than people imagine. So it's later in the year. Because people are so scarred by last time around again. And if I look at it on a probabilistic basis, when we took off so aggressively in 2023, I'm like, okay, look, there is a chance that we front load the cycle. But then we had a 8-month correction, and that kind of put it back on track. And so therefore, I think we've got two odds now is, does this look like a more normal cycle? What that means, I don't even know anymore, but let's say 250,000 Bitcoin.
Mm-hmm.
Or do we get something like 2017 and 2013, which is something a bit wilder? And I think the probability has gone up for me of that. But, I don't make predictions on this stuff because it's pointless and you just get trolled on the internet for making predictions. But probabilistically speaking, from what I know today and what I know about liquidity and the regulations and everything else, the probability is that we're going to get a more violent upside cycle with lots of volatility in the middle. Like, liquidity has been falling for 2 months now, 3 months. It's fallen quite sharply. And that's whether you use Global M2 or whether you use our Global Liquidity Index, total liquidity, that we produce at Global Macro Investor. It maps really well on Bitcoin. Now, these correlations don't last forever in a perfect form, but it's been perfect. And it would suggest that the market peaks sometime December, end of the year, early Jan, and sharply corrects, which is exactly what happened last time Trump came in. When Trump got voted in, the dollar screamed higher, rates went higher. He actually came in, rates went lower, the dollar went lower. But that run-up over the Trump getting voted in 2016 caused a 35% correction in January of 2017. In the end, it was all noise. But, we're going to get to that. We're going to get to very frothy. Some people are worried it's happening now as we speak. Maybe. Doesn't look like it according to my work. It would suggest later. But, who the hell knows? But we'll get one of those to come. Then we'll have the post-US tax season version as well. Because in the end, people are going to have a lot of gains. And if they've switched anything around, they're going to have to pay the tax man a lot of money. And they have to sell stuff to realize profits. And that's that kind of sell in May and go away idea that generally works. It's tax season. Don't lose control of your tokens. And any leverage in some larger drawdown means that you end up getting taken away and your coins don't belong to you anymore, and then you're out of the game. And that's, if it's going from 3 trillion to 100 trillion, rule number one is don't get out of the game. Or don't get taken out of the game.
Pal's overarching message is one of patience and perseverance. With the crypto market poised to grow from $3 trillion to $100 trillion, he advises investors to prioritize staying in the game. Avoiding leverage and ensuring control over one's assets are paramount, especially during periods of market turbulence. Bitcoin, while likely to lose some dominance as the ecosystem matures, is expected to remain a cornerstone asset. Pal predicts its market cap could rival or exceed gold's, potentially reaching $30 trillion. Meanwhile, other segments of the crypto market will offer substantial opportunities, particularly for early-stage projects in their growth phases.
For Bitcoin, that will become a very real thing earlier. But for the entire space, if it's going to 100 trillion and it's only 3 trillion today, will Bitcoin dominance be 50% of a 100 trillion market? No. Where will it be? Where will it settle as an asset class? We don't know. But let's say it'll have the equivalent or larger than gold whenever gold is at that stage. So let's say it's 30 trillion. So there's the 70% that's going to make an extraordinary amount of money. So I think the S-curve applies to the whole space overall, but the returns are still relatively high to come because we're still pretty early in most of this. And we see that over time. So Bitcoin's returns are coming down. ETH was higher, still is higher, but it's coming down. Solana's higher, but will come down next cycle. Sui or whatever's coming up this cycle, it will still have a couple of acceleration cycles, then it slows down. But what are we going to argue about? That the returns have gone from 150% a year to 60% a year? I mean, this is la-la land in finance, right? Nobody gets given these opportunities. What is a harder thing is why even start a business? Because I don't know almost any business that consistently generates between 50 and 150% a year returns. And you actually don't need to do anything. You just need some capital. There is an industrial savings complex whose job is to say, listen, what you need is diversification and you need us to help you manage it. It's far too complicated for you. And in return, we'll give you 8 or 9% returns. But they're not understanding that their audience has changed. Their audience is not baby boomers who did pretty well in their careers and had some savings, even though the baby boomers are actually very skewed. There's a whole bunch with no savings at all, because the system let them down too, which was their savings never equated to an ability to retire. The median 401k in the United States of a baby boomer is $150,000. They're so fucked. Mm-hmm. But you see the average is miles bigger. It's over $1 million. Why? Because it's skewed by the super rich. But then when you go to younger people, 8% returns, considering they've come out of university in debt, considering house prices are 10 times incomes or more, have zero chance of getting up the ladder on an 8% return. So there's the boomer industrial savings complex trying to tell them what works for those guys, but not what works for the customer. And the customer, the client, has a very different need. And so what they've done is that trust broke down in 2008 and 2012 in Europe. The trust of banking, the trust of intermediaries, trust of the middleman, trust of the system. And people have taken it into their own hands. And it's not just in crypto. We see the massive rise of retail trading of options in tech stocks. Mm-hmm. Right? It's the same phenomena. People have had to become more speculative in order to get ahead. It's a real thing. So I think that is an important thing to note. It's all about what's the incentive and for whom. Mm-hmm. And we have misaligned incentives right now. The boomer industrial savings complex wants one thing, which is your fees, and we want another, which is performance. And they're not going to give it to us because volatile assets don't make as much fees as stable assets in massive size. It's a simple equation.
Mm-hmm. The rise of speculative trading among retail investors reflects broader societal shifts. With limited access to traditional wealth-building avenues, many have turned to crypto, tech stocks, and options trading to bridge the gap. While this approach carries risks, it also highlights the transformative potential of decentralized finance and digital assets. Pal acknowledges the volatility inherent in these markets, but argues that the potential returns far outweigh the risks. He points to the declining but still extraordinary returns across crypto assets, from Bitcoin to newer entrants like Solana and SUI, as evidence of the sector's unparalleled opportunities.
Please like and subscribe my channel.